and getting divorced are the two of the biggest life events a person goes through, and both of them can dramatically change your tax situation. Whether you just said I do or you're navigating a separation, this video will help you understand exactly what changes and what to watch for and how to protect yourself financially. Welcome to taxmerica.co. I'm Sharon, and today we're covering one of the most searched tax topics around major life changes. In part 1, we'll cover how marriage affects your taxes, including the marriage bonus, the marriage penalty, and the smart moves newlyweds should make right away. In part 2, we'll cover divorce, how it changes your filing status, In part 2, we'll cover divorce, how it changes your filing status, and what happens to joint depart, and the tax treatment of alimony and assets transfer. Big topic. Let's dig in. Your filing status changes everything. Your marital status on December 31st determines your filing status for the entire year. If you got married on December 31st, you're considered married for the full year for tax purposes. If you got divorced on December 31st, the same thing. So the timing of major life changes matters. Married filing jointly versus separately. Most married couples file jointly. You combine your incomes and deductions on one return. The standard deductions doubles $29,200 in 2024. Tax brackets are generally wider. You can claim most credits: EITC, education credits, child credits. This is usually the best option for most couples. Married filing separately, MFS. Each spouse files their own return with their own income and deductions. The standard deduction is $14,600 each. You lose eligibility for most credits. This is rarely beneficial, but there are specific situations where it makes sense. If one spouse has significant medical expenses and needs a lower AGI, if you're on income-driven student loan repayment and don't want to combine incomes, or if you simply cannot access your spouse's financial information due to legal issues. Taxmerica.co runs joint versus separate calculations for every married client before filing. In most cases, filing jointly saves thousands, but not always. It depends on your specific numbers. The marriage bonus versus the marriage penalty. The marriage bonus. When one spouse earns significantly more than the other, married couples often pay less tax together than they would as two single people. This is because combining incomes keeps you in a lower brackets than the higher earner alone. For example, spouse A earns $200,000, spouse B earns $20,000. As singles, spouse A is in the 32% bracket. Together, the MFJ bracket structure gives them a better combined rate. The marriage penalty. When both spouses earn similar amounts, especially at higher incomes, they can end up paying more tax together than as singles. This is the marriage penalty. It's most noticeable for dual income couples earning over $200,000 each, where combined income pushes them deeper into higher brackets. The Tax Cuts and Job Acts reduce the marriage penalty significantly, but it still exists at the higher end. Immediate steps after getting married. Update your W-4. Your withholding as a single person is now wrong. Both spouses need to update their W-4s with their employer immediately. Use the IRS withholding estimator, or better yet, have taxmerica.co calculate the optimal withholding to avoid owning a large amount at tax time. Update your social security name if you changed it. Your name on your tax return must match what's on file with the Social Security Administration. Review beneficiary designations on retirement accounts, life insurance, and estate documents. Combine or separate finances strategically. Talk to a financial advisor about what makes sense for your household. Consider a mid-year tax projection if you got married mid-year. A taxmerico.co advisor can calculate your projected tax liability for the year and help you adjust withholding before it's too late. Community property states. If you live in Arizona, California, Idaho, Louisiana, Nevada, New Mexico, Texas, Washington, or Wisconsin, you're in a community property state. In these states, income earned by either spouse during the marriage is generally considered equally owned by both. This affects how income is reported and allocated. Especially important for married, filing separately, returns and in situations involving different citizenship or residency status. Community property rules are complex, and if you are in one of those states, professional guidance is strongly recommended. Combining different financial situations. What happens when one spouse has significant debt, back taxes, or an IRS issue? If your new spouse owes back taxes and you file jointly, your joint refund can be seized by the IRS to satisfy their debt. The solution: file an injured spouse claim using Form 8379, which protects your portion of the refund. This must be filed with your joint return or separately after the IRS takes the refund. Here is a pro tip. Before filing your first joint return, have a frank conversation with your spouse about any IRS issues, prior tax debt, or unfiled returns. Taxmerico.co can help you enter marriage with clean tax slates. Part 2. Divorce and taxes. Emotional and financial reset. Divorce is emotionally difficult, and the last thing most people want to think about is taxes. But some of the most costly tax mistakes happen during or immediately after divorce precisely because people aren't thinking clearly about the financial implications. Let's make sure that doesn't happen to you. Filing status after divorce. Your marital status on December 31st is what counts. If your divorce is finalized by December 31st, you're single for the entire year. If it's not finalized by December 31st, even if you've been separated for 2 years, you're still considered married. Options for that last year: file jointly. Requires both spouses' cooperation and signatures. File as married filing separately, usually less favorable. Or, if you have a qualifying dependent and meet other requirements, file as head of the household, which has a better rates at a higher standard deduction than single. Alimony tax treatment. Pre-2019 divorce agreements. If your divorce was finalized before January 1st, 2019, alimony follows the old rules. The payer deducts alimony from their income and the recipient includes it as a taxable income. This can have significant planning implications. The recipient may owe substantial tax on alimony receipt if they don't adjust withholding or make estimated payments. Divorce agreements. For divorces finalized on or after January 1st, 2019, alimony is no longer deductible by the payer and is not taxable to the recipient. This is a major change that flipped the tax burden. Under the old rules, the payer got a deduction. Under the new rules, they got nothing. This affects how divorce settlements should be structured financially. If you're currently negotiating a divorce settlement, the tax treatment of alimony versus lump sum property division can mean dramatically different after tax outcomes. Have a tax professional review the settlement before you sign. Who claims the children? Generally, the custodial parent, the one with whom the child lives with the greater number of nights, claims the child tax credit and head of household status. The non-custodial parent can claim the child if the custodial parent signs Form 8332, releasing the exception. Some divorce agreements alternate years. Whatever your agreement says, make sure it aligns with the IRS rules. Verbal agreements don't override tax law. Childcare expenses. The parent who pays childcare expenses claims the child and dependent care credit, but only if the child is in their custody. Coordinate carefully to avoid both parents trying to claim the same expenses. Dividing retirement accounts. Retirement accounts like 401ks and IRAs are often the largest marital assets. Dividing them incorrectly triggers immediate taxes and a 10% early withdrawal penalty. The correct tool, a Qualified Domestic Relations Order or QDRO for workplace plans. IRAs use a direct trustee-to-trustee transfer instead. When done correctly, there's no tax or penalty on the transfer. When done wrong, by simply taking the money out and writing a check to your ex is fully taxable distribution with a penalty. Do this right. Home sale in divorce. If the marital home is sold as part of the divorce, the capital gains exclusion of up to $500,000 married filing jointly may still apply if both spouses lived in the home for 2 of the last 5 years. If one spouse is brought out and later sells alone, they get the single exclusion of $250,000 timing and structure matter. Get a tax advice before finalizing the home sale terms. Innocent spouse relief. If you signed a joint return that contained errors or underreported income you didn't know about because your spouse handled all finances, you might qualify for innocent spouse relief. This can release you from the tax liability your spouse created. There are 3 forms of relief: traditional innocent spouse, separation of liability, and equitable relief. These must be applied for within 2 years of the IRS collection action. Key takeaways. Marriage. Update W-4s immediately. Choose filing status wisely. Watch for the marriage penalty. Check your state. Community property states have unique rules. File Form 8379, injured spouse, if your spouse has tax debt. Divorce. Finalization date determines filing status for the entire year. Alimony rules differ dramatically pre versus post 2019. Know which applies to you. Use a QDRO to divide retirement accounts without tax consequences. Address joint tax debt before finalization. You remain liable after divorce. Life changes are hard enough without tax surprises, making them harder. At taxmerica.co, we've helped hundreds of clients navigate the tax side of marriage, divorce, and everything in between with expertise, discretion, and care. Visit taxmerica.co to book your free consultation today. Like this video, subscribe for more, and we'll see you next week. If this video helped you, like it and subscribe for weekly tax tips. Drop your questions in comments and we read every one. Book a free 15-minute tax consultation at taxmerica.co and let your experts handle your taxes stress-free this season. Thank you.